Hello, everyone. Thanks for joining and welcome back to Wall Street Bullion. Our guest today is Steve Hanke. Steve is a professor of applied economics at Johns Hopkins University and a distinguished senior scholar at the Mises Institute. He served on President Reagan's Council of Economic Advisors. He's also an author of two recent books, Capital Interest and Waiting and Making Money Work. Thank you for joining us, Steve.
Great to be with you, Ivan.
Yeah, it's great to have you on. I wanted to get you on to talk about everything that's happening in the U.S. economy, interest rates, what's happening with the financial bubble that we're in. I'll start it off, I guess, with why do you consider or what do you consider the primary causes behind the rapid accumulation of U.S. federal debt? Like now it's surpassing 36 trillion. It's 122% of GDP. Why has the issue accelerated over the past decade?
Government spending. Spend, spend more than you take in, and you run a deficit, and that deficit just keeps piling up into a mountain of debt. But it's really the government spending aspect that's driving it.
Are there any early warning signs that you're seeing, Steve? Like any tipping points that suggest the U.S. debt bubble could trigger a financial crisis in the near future? What si signals do you look for?
Well, the way that this works back in, you get into kind of a potentially. I'm not predicting this, but you could potentially get into kind of a doom loop, and the doom loop is that the debt level does hit, as you said, a tipping point, and people lose confidence, and they, as a result, to hold U.S. government debt, to buy it and hold it, you've got to be paid a higher interest rate. And that higher interest rate then works back into the budget itself because the interest expense, which is running over 13% of the budget right now, a huge amount. We're just paying 13% for nothing. I mean, that we get nothing for it. We're just
Yeah.
paying credit, just paying creditors, and as that percentage goes up, it basically squeezes other things out of the budget. So that's the doom loop kind of situation that you get into. And by the way, this happens often in less developed countries. And then you get into currency crisis and the financial crisis and so forth. It typically hasn't happened in the United States, mainly because the U.S. dollar is the international currency, and everybody wants to get into the dollar. They want dollar asset exposure.
Yeah. Hello, my fellow silver and gold stacker. I just wanted to say thank you so much for watching the channel. Subscribe, please like the video, and also hit the notification bell. Keep stacking. Does it, sorry to cut you off, but like, does it affect the stability of the broader financial sector, the private borrowers, households? Like, how does it trickle down?
Well, it trickles down. I mean, one of the main things is that right away, if under the hypothetical scenario, the doom loop scenario that I've just given you, with higher interest rates, if the 10-year yield, which is a key yield in the United States, if that goes up, mortgage rates are going to go up, and if mortgage rates go up, that means housing and real estate is going to be softer than would otherwise be the case, and that's a big important sector. And many times, by the way, business cycles, the downturns are created by problems in the real estate sector.
Right.
Just look at 2007, 2008, the great financial crisis. Why did that occur? It occurred because of problems in the mortgage sector and the housing market.
Right.
And that's international, by the way. That housing is very important. I don't care what country you're in. It's a big important sector, and it's relatively sensitive to interest rates. And the reason why is because people involved in real estate, there's a lot of leverage. You don't go in and buy a house, most people, for cash. You take out a mortgage.
Yeah.
So the housing market's highly leveraged, and leveraged with what? Well, mortgages, and that's why it's highly sensitive.
How do people protect themselves, Steve? Like right now, or just to prevent maybe another 2007, 2008 scenario, what can the individual do? What can governments do? What do you think in the broader sense you can do to prevent being hurt from a next financial collapse?
Well, I think one, on the individual basis, of course, you better, if you're holding bonds, well, that under the scenario I gave you, that might be problematic, because if the interest rate goes up, the price of the bonds go down, and you have a capital loss if you're holding bonds at present. So that's, if if you think interest rates are going up because of excessive debt and the lack of confidence in the fiscal situation, then that is an area where you don't want to be. Now, equities, or let's put it this way: you got to be careful, and being that would, how do you be careful in that kind of situation with bonds? Well, you go on the short duration. You don't want to be out very long duration. If you think interest rates are going up and the yield curve is going to get steeper, relatively steeper, you want to be holding more short-term instruments, not long-term instruments. So that's one way to mitigate the damage of the bonds that you're holding, under the conjecture that interest rates are going up. In the stock market, I think we are in a bubble. My bubble detector indicates we are definitely in a bubble. But the problem is, no one can predict if the bubble, number one, if it's going to pop. We don't even know if it's going to pop,
Right.
because the other alternative is that the bubble, the air just slowly comes out of it, and valuations come down to more reasonable levels. So so that you're kind of exposed. We're in basically a speculative frenzy in the U.S. stock market, and other markets. By the way, just look at Bitcoin and cryptocurrencies. I mean,
Right.
they go up. I mean, Bitcoin is is a speculative asset, but it has no fundamental value.
Right.
There's nothing underlying it, but it just goes up. So that is that's coincident and complementary to my measures for the bubble. It just means there's a lot of speculative froth right now, and I don't think that's wise, because we have a lot of what I call regime uncertainty being created in the United States by Trump, as well as internationally, because uh, everything is changing. And when everything changes, that means the regime is changing.
Yeah.
It's like a revolution. I mean, we haven't seen tariffs like the ones Trump is imposing since the 1930s with the Smoot-Hawley tariff.
Right.
So so it's a complete change. And when that happens, you get regime uncertainty. And when you get regime uncertainty, interest rates should go up, because to be risk on, you should be receiving a higher rate of return, a higher interest rate. But we haven't seen that really yet. I think we will see it. The last time we had regime uncertainty in the United States was in the Great Depression, when Franklin Delano Roosevelt and the New Dealers came in. They were changing everything. The New Dealers, everything was being changed. You had a lot of regime uncertainty, and as a result, an investment just ground to a halt. I mean, from 1929 until the start of World War II, the investment was zero in the United
Wow.
States. So the Great Depression, one reason it lasted as long as it did and was as deep as it was, is due to the regime uncertainty created by the new dealers who were changing everything.
Right.
I mean, they took, they removed unilaterally the gold clause on contracts in the United States. So it was pretty. I mean, that's just outright theft.
And do you think that's why Powell is holding his stance right now and not lowering interest rates and just keeping them the same because he sees this regime uncertainty like you're mentioning?
I think that's a main factor. Yes,
Yeah.
I think the regime uncertainty. They put it in other terms. They don't talk about regime uncertainty. They just say, "Well, we don't know how this tariff thing's going to play out, and
Right.
we'll wait and see." But that's part of the regime uncertainty aspect of the thing.
Right. What are your thoughts on people protecting themselves with precious metals like gold and silver and so on?
Oh, I'm all in.
Right.
I mean, I've been a bull in the gold market for ever since the bull market started, and it hasn't stopped.
Right.
So I was getting that way. The first things we've been talking about, Ivan, are kind of defensive things like the bond market, the stock market. Make certain you're only holding stocks and sound companies. I would say at this point, avoid speculative bets,
Yeah.
that kind of thing. Uh, in short, be conservative, but on a more proactive basis, you want to be maybe cutting back a little bit in the bonds, cutting back maybe quite a bit in stocks, but going into the gold.
Welcome to the Cayman Islands, a premier offshore jurisdiction where natural beauty meets financial stability. Here, your wealth is more than secure. It thrives in one of the most trusted and respected financial centers in the world. For over a decade, SWP has been the trusted choice for precious metal investors worldwide. Our purpose-built 6,000 square foot facility sets a new standard in precious metals storage. We are proud to be one of the only vault operators approved by the London Bullion Market Association. Beyond safeguarding your assets, we're committed to making a difference in our community by supporting local causes and events that reflect our values. As we continue to expand and innovate our services, we ensure that your wealth is safe and strategically positioned to shield you from the uncertainties that lie ahead. Strategic wealth preservation, trusted today and ready for tomorrow.
Yeah, absolutely. That's a huge stance for us right now especially in our community on our channel is for sure protecting yourself with precious metals, getting into gold and just being like what you said is be proactive in that sense.
Right. If you don't have any gold, check with somebody the vehicles that you can get exposure with, and get in there. Maybe for a rookie, maybe 10% of your portfolio.
Right. Yeah, no, I totally agree with you. Steve, I want to thank you so much for joining us and speaking to the silver and gold community. I'm going to put the links to your books in the description below. So anyone watching this, I highly recommend you to go check out Steve and the recent books that he's written. Is there any social media you have, Steve? Anywhere else people you'd like to follow you?
Yes, yeah, they can follow me on Twitter. I have almost 806,000 followers right now.
Wow.
I'm the I'm the third most influential economist on Twitter in the world, actually. So
Wow.
that handle you can put up, Ivan. It's at Steve_Hanke.
Yeah, everyone watching this, I highly recommend to go follow Steve on Twitter. That handle will be in the description below as well. But Steve, I want to thank you so much for taking your time and speaking to the precious metals community, to the investing community on this channel. And yeah, as the market develops and all the craziness in this administration,
Yeah.
I'd love to have you back on in the future.
Well, I look forward to it, Ivan. Thanks for having me.
Talk to you soon.
Okay, thank you.